Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap in Capitalize. And on today's episode, I'm going to get into 9 new retirement numbers that you need to know for 2026. Now, before we get into the episode, as always, the free advice for the week. And it does tie into some of the things that we're talking about. The things in life that you should always pay up for: toilet paper, beds, underwear, tax advice. If you pay up for those 4 things, you will have a premium on your life. Now that we've got that free advice out of the way, it is time to get into the 9 retirement numbers that you will need to know for 2026. And the IRS released a number of changes to the tax code, like a plethora of them, but a lot of them, frankly, just won't be pertinent to you. So I wanted to give you the most important and, frankly, relatable information to your circumstance. So with all of that, we're going to dive right into it. So the first number that you're going to need to know is for 2026 for 401k plans, 403b plans, 457 plans, and thrift savings plans. People can contribute a total as an employee of $24,500. That is an increase from last year's 2025 of $23,500. Now, this is for if you're under 50. We'll talk about 50 and over later on in this episode. So the second number that you're going to need to know is with IRAs, and that's whether it be a Roth IRA, or a combination of the two. The annual contribution has increased in 2026 to $7,500. Again, that's per person. And in 2025, it was $7,000. So just to reiterate, that means you could put $7,500 in an IRA. You could put $7,500 in a Roth IRA. You could put $7,500 in a balanced combination between the two, but you cannot put in $7,500 in an IRA and a Roth IRA for yourself, just to be crystal clear on that. And actually, going back to number 1, if for whatever reason you do have multiple retirement plans, it has to add up to that $24,500. Technically, 401ks and 403bs are lumped together, and 457bs can be outside of that. So there are rare circumstances where you could actually put in $24,500 to a 403b and $24,500 to a 457b. And I see this is extremely common in, I'll just say, clients that we work with that work for universities, where you have a 403b plan, nonprofit side, but then a 457b plan, which is the governmental side of things. So number 3, so with IRAs, the catch-up contribution limit for people 50 and above is raised to $1,100 in 2026, which is up from $1,000 in 2025. So what does that mean? So if you are 50 or older with an IRA or a Roth IRA, instead of putting in $7,500, it's $7,500 plus $1,100. So it's really $8,600 for 2026. The fourth number you need to know is catch-up contributions. And this comes back to what I was talking about with 50 and older in retirement plans. So the catch-ups for 401k, 403b, 457s, and thrift saving plans has increased to an $8,000 contribution increase in 2026. And that is up from $7,500 in 2025. So this means that in total, if you are 50 or older, you can contribute a total as an employee of $32,500 $500. Now, I keep repeating employee because technically there are 3 ways to contribute to a company retirement plan. You can contribute as an employee, which is from your payroll, which most people, that's what you can focus on. You can contribute as an employer match, and you can also give a company a profit sharing contribution, which ironically, you don't actually have to have a profit in the business to contribute a profit sharing portion of your plan. But I'm not going to get into that in this episode because that gets a little squirrely and goes over most people's heads. But if you do run a business or if you're a sole proprietor that has an extremely high income, shoot me a message and then I can tell you what would be most optimal for you regarding your most likely 401k plan. So number 5. So speaking of catch-ups, there is a specific catch-up for people 60 to 63, which is odd. And this is very unique, and it was in the Secure Act 2.0 in 2025. So 2026, the higher catch-up contribution remains the additional $11,250. So if you are between 60 and 63 years old, you can contribute a total of $35,750 to your 401k, 403b, 457, or thrift savings plan in, again, 2026. Number 6. So there is an income phase out range that you need to be aware of if you're thinking about contributing to a Roth IRA. So the income phase out ranges for taxpayers making contributions to Roth IRAs is $153,000 to $168,000 for someone that's single or if you're a head of household. And that is up from $150,000 to $165,000 from 2025. For those of you that are married, filed jointly, madly in love, the phase out is $242,000 to $252,000 in 2026, and that is up from $236,000 to $246,000 in 2025. So you also got a little bit of a bump. Now, one quirky rule, this isn't going to apply to the majority of you, but there are a few of you out there. The phase-out range for married couples filing separately who make contributions to Roth IRAs is not subject to an annual cost of living adjustment, and that actually remains between $0 and $10,000. So again, most of you are not going to even think about that. I can tell you in my career, there's been 3 cases where it's been more appropriate for a client to file separately. So, I just threw that in there because that's the type of guy that I am. But the point that I'm making is the phase out limit has increased. So for you just need to be aware of where your income is. And then if you are thinking about making a Roth contribution to an IRA, you need to be either under that limit to have no issues, or if you're within those limits that I mentioned, and if you need to just rewind the episode and pull those up and write them down, you need to know how much you can put in on a pro rata basis. And then if you make anything above and beyond that, you cannot contribute to a Roth IRA directly. Now, there is a workaround with that. If you make above the threshold limit, you could contribute to an IRA, non-deductible IRA, so you don't get the deduction. And then the next day, because you've paid the tax, you convert that money to a Roth IRA. It's called the backdoor Roth IRA conversion. So that is a unique way for you to put money into a Roth IRA. One thing that you need to know about Roth retirement plans. So again, Roth 401k, Roth 403b, and Roth 457b, there is no income limitation in terms of how much you can make if you want to put into Roth. Now, granted, if you are in a higher tax bracket, not giving you direct advice, but you're probably not going to want to pay those taxes. That's why you want to put in traditionally and avoid that tax today and pay taxes in a lower tax bracket down the road. But without getting too into the weeds of that, I just wanted to give you those bonus nuggets on Roth IRAs. Number 7, and this is regarding simple plans. So contributions to a simple plan, which stands for Savings Incentive Match Plan for Employees. And again, this is a small business retirement plan. Personally, I'm not a huge fan of them. I think simples are kind of stupid and they're kind of outdated, but there are rare circumstances where it does apply and it can be appropriate. They're just kind of a pain in the butt, but that's another point. The contributions to these increased to $17,000 a year, and that's up from $16,500 in 2025. Without getting into details, under the Secure Act 2.0, there are certain simple plans where you can contribute a smidget more, and that is $18,100, which is up from $17,600 in 2025. But for the majority of you, it's $17,000. Now, number 8 that you need to know as far as the retirement numbers, simple catch-up contributions. So this is increased to $4,000 of additional contributions in 2026, and that's up from $3,500 in 2025. So, if you're 50 and over, instead of $17,000, you're able to put in $21,000. Keeping in line with what I said a moment ago, there are certain simple plans under the Secure Act 2.0 where people 50 and older can contribute a little bit more, and that limit stays at $3,850. And anyone 60 to 63, the bonus contribution stays at $5,250. And I'm ripping through this one pretty quickly because, frankly, I just don't see a lot of simple plans anymore, but they are out there. And the last one, and certainly not least, are qualified charitable contribution limits, QCDs. So if you are 70 or older, you can make qualified charitable contributions, which is a tax-free direct transfer from your IRA to a qualified charity. So it has to be a 501c3 eligible charity. That total amount has increased to $111,000 in 2026, and that's up from $108,000 in 2025. Now, why would you do this? Why would you utilize a qualified charitable contribution? Well, first off, you want to make sure that you've saved up enough for retirement, et cetera, et cetera. So let's say that you've saved up enough for retirement and you have money in a 401k or an IRA when you roll it over and retire. Let's say that you have money in your Roth IRA, assuming you have one, and you have a brokerage, an investment account, a non-retirement account. And you do the analysis and you realize very quickly you could live off your taxable money, and you could also live off of your Roth IRA money. And I use the standard deduction. Let's assume you're married, filed jointly, and you're at that 70.5 or above. Well, if you're married, filed jointly at 70.5 or above, you get a standard deduction of $31,000 plus you get a senior deduction of $6,000 per person. So really you get $43,000 in standard deduction. Why is that valuable? Well, the first $43,000, remove Social Security for a second because that gets a little squirrely. The first $43,000 that you would take from your IRA is completely written off with the standard deduction. So that's taxed at zero. Well, Roth is tax-free regardless. And taxable money, if you have a capital gain, married, filed jointly, the first $98,000 approximately is considered 0%. So it'd be a 0% tax bracket. So you could take $43,000 from your IRA, plus you could take an additional $98,000 from your taxable account. You do the math on that. That's what, 100 and again, I have a newborn, very little sleep. So give me a moment here. That's what, $130,000 approximately, and you're paying zero in tax. Well, it's a first world problem, but let's say that you get to your required minimum distribution age at 73 and you realize, whoa, I have to take a fat required minimum distribution, because at 73, when you have an individual retirement account, whatever the dollar amount is irrelevant. Think of it as you have to take a percentage, which is about 4% of the total IRA value, whether it's one IRA or multiple that you add up, and you have to distribute that. Well, if you distribute that money to you, it is taxed at ordinary income. Well, for tax purposes, that's not great. So let's say that with your RMD, you took up to $111,000 of that and you gave it to qualified charities as a qualified charitable distribution. That $111,000 completely jumps over your tax return, and you would show zero income from that $111,000. So not only are you being charitably inclined, you're saving $111,000 times whatever your tax bracket is. And if you're able to do this at this rate, you're talking at least 25% of that. So 111 times 25, you're basically making 30 grand in taxes that you're not paying. One cool thing with qualified charitable distributions, it's per person. So I'm just going to use me and my wife. We're a far cry from 70 and a half. Oh, that's crazy. I'm exactly halfway there. That's weird. But neither here nor there. If my wife wanted to take $111,000 and I wanted to take $111,000 from my IRA in her IRA, you could do that. So in theory, if you're married filed jointly, you could take a total of $222,000 from IRA contributions and convert it to qualified charitable distributions, which is a massive benefit from the tax saving side of things. I know I went a little overboard on this last one, but qualified charitable distributions, say that 10 times fast, are extremely valuable, highly underappreciated, and they need to be talked about more. And that segment right there, if you're listening and you're around that age, you could be saving yourself hundreds of thousands of dollars by doing a qualified charitable distribution here or there. It doesn't have to be the max, but if you're doing the max, you're welcome. So that does it for today's episode. As always, I'm your host, Chris Ray Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Ray Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. Any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with the Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Christopher Panagiotou is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning.